Assalamu alaikum. This is lecture number 20 of Advanced Cost and Management Accounting. We have been talking of budgeting, and in our last section we have seen how a budget is prepared given some initial data. We have seen that the budget should be based on the sales. The entire budget, as we said, is a plan for the forthcoming year or whatever the relevant budget period is, and the basis of making the plan is the sales budget. So initially and primarily, the organization must have a sales budget, a forecast based on market analysis and research, and that sales budget will then set out what should be the production budget, what should be the purchasing budget, what should be the inventory levels, and things so on. Therefore, the importance of the sales budget has to be emphasized. And then we went on and we prepared, after preparing the sales budget, we prepared the materials usage budget, the materials purchase budget, and an income statement. One important aspect that we covered, and it perhaps is worth reminding ourselves, was the inventory valuation. Inventory valuation is an important aspect of budgeting and as well as accounting. It is laid down in international standards, and it is normal accounting practice to value inventories at the end of the period, and the basis of valuation is quite important. Normally, we are talking about finished goods inventory. That finished goods inventory should have the cost that has been incurred for material and labor, etc. It must also have a proportion of the overheads allocated to the finished goods. So we saw in our example how we tabulated all the overheads that were incurred during the year or during that period, and a total of the overheads was identified. And then we saw that using some basis and looking at the number of units, we arrived at a rate per unit of overheads, of the complete total overheads. That included the variable overheads as well as the fixed overheads. So this becomes a full absorption basis. So on the full absorption basis, the variable overhead and the fixed overhead put together, and they were then formulated into a rate per unit. So therefore, 1 unit of finished good inventory comprised of the direct labor, the direct material, direct cost, plus an allocated rate of per unit overhead allocated to it. So that gave the total value, as it were, of the finished goods. So finished goods were valued in that way, and they were used then in the budget for the income statement. After the income statement, we are going to look at the budgets for cash, and of course we are going to also look at a budgeted balance sheet. So it's important to even forecast your balance sheet figures for the entire budget period to foresee what would be the balances at the end of the budget period, even if it is 1 year. So we'll start by looking at the budgeted balance sheet. Balance sheet is going to comprise of fixed assets, current liabilities, and the equity portion. Under fixed assets, land value rarely changes unless you have a re-evaluation of the land values. Normally, land is quoted at cost and there is no depreciation of land, so that amount nearly remains fixed every year. So in this case also, the opening balance sheet was showing land at a value of 170,000, and this balance sheet will also show land at a value of 170,000. Buildings and equipment were 1,292,000. This is in cost, and the depreciation has to be deducted. Now, this balance sheet depreciation of 435 is going to include the depreciation that has been charged for the current year, and therefore the revised net book value of 857,000 is going to be incorporated in the balance sheet. This gives the total fixed assets of 1,027,000. We have seen that the depreciation is something that adds every year. It's an annual charge, and this we will see the working of depreciation and other balance sheet items later on as we look at the workings. Current assets are showing raw material at 100,640. Finished goods are 665,984. This is as per the valuation we carried out in our last session. Debtors, we will see the working 280,000. Cash, we will have an entire cash budget which will show the cash inflows and cash outflows, and that amounts to, at the end of the period, 1,245,794. Creditors, again, we'll see how it's worked out, and creditors amount to 307,884. So the net current assets are 937,910. Add that to the fixed asset and you get 1,964,910. This is represented by the equity portion. There are 120,000 ordinary shares of 10 rupees each. This amounts to 1.2 million. The reserves stand at 369,476, and profit and loss account as calculated in the previous session is 395,434. So this also gives a total of 1,964,910. That's the budgeted balance sheet. So the balance sheet is going to show all the assets and liabilities, and we have said that land will remain at usually cost unless it is revalued. Other assets such as buildings and equipment and vehicles and office equipment and furniture, all those assets are going to be depreciated, and depreciation is an annual charge, and this is an annual fixed charge. So this will be an annual fixed cost charged to the profit and included in depreciation, which is deducted from the value of the assets to be arriving at the net book value. So you arrive at the net book value of the fixed assets, and then there are current assets. For current assets, stock, we said inventory is going to be valued. There is the basis of valuation, which will include the proportion of overhead. Debtors, we will just see the working in a minute. Debtors, for the purpose of examination and for the purpose of calculation in the questions, is going to be arrived at by using what normally in accounting is known as the control accounts, by taking the total amount of debtors at the beginning of the period, looking at the total sales made, add to that, and then deduct the total cash received. So this is the total control account, and the balance will represent the debtors at the end of the period. A similar working is done for creditors, that you take the creditors' opening balance to start with, and you add to that all the purchases made during the period, and then deduct the payments that have been made during the period to arrive at the balance of creditors, which goes into the balance sheet. So this is on the total account basis, the balances of debtors and creditors. Cash we are going to look at separately. Cash is going to be reflected in the cash flow statement or the cash budget. The cash budget will show details of cash inputs, cash inflows, and all cash outflows. So these are the other major elements in the balance sheet. We will look at the workings at the moment to see the details of the amounts shown in the balance sheet. You can relate those to the information given in the question and make sure that you understand how this is the working is done to arrive at these figures. Let's look at the workings. Depreciation in the opening balance sheet was stated at 255,000. There is a charge for this period of 180,000. This gives a total now showing in the balance sheet depreciation of 435,000. The debtors, as we just said, are going to be computed from a total basis. The total of the opening balance of debtors was 289,000. Add to that the total sales shown in the profit and loss account of 4,296,000 and deduct from that the cash received during the period from the debtors. This cash received total can be seen very shortly when we look at our cash flows. So incorporating the cash received here, we get the balance of debtors of 280,000. The cash which is shown in the balance sheet is going to be the closing balance as per the cash budget. The working, we said, for creditors is similar to that of debtors. We take the opening balance from the opening balance sheet. We add to that all purchases made during the year. In this case, we are going to add the purchase of indirect materials also, which is 141,660, and we are going to deduct the cash paid. Again, the cash paid is going to be seen from the cash budget when we look at the inflows and the outflows. The cash payments are 1,876,984, and this gives a balance of creditors of 307,884. So we have now looked at the profit and loss account and the balance sheet, and we have seen some preliminary workings that are performed to arrive at these balances. The profit and loss account balance required working of inventory, working of the valuation basis of inventory, and the balance sheet workings as we have just seen. Next, we are going to move on to the cash budget. The cash budget simply represents inflows and outflows of cash. It's essential to forecast the flows of cash to be able to plan what would be the balance of cash at the end of each interval and intervening period. For instance, if the cash budget is prepared for one full year, then it is appropriate to find the balance at the end of each month. Take the opening balance, inflows and outflows, and you have the balance at the end of the month. That becomes the opening balance for the next month. Inflows and outflows, you arrive at the closing balance for the next month. So at the end of each month or whatever suitable period, you have what would be the cash balance for the organization. Why is this cash balance important? The cash balance is important because it might be negative in some periods. If it's negative in some periods, that means the outflow or the expenses exceed the inflows. And when that happens, then some arrangement for funds and finance will be required by the organization to meet that excessive outflow. This might mean looking at temporary bank advances. It might mean other arrangements. Some financial arrangements will need to be made where there are negative balances. In the same way, where there are positive balances, the organization will attempt to invest those short-term positive balances and obtain return on its investment. Let's look at the slide. Cash budgets help a firm to identify cash balances that are surplus to its requirements. These can be invested in the short term. Where short-term balances arise, it would be appropriate to invest those in the short term. Invest those if you expect to hold them for 1 week, to invest them for 1 week. If you expect to hold them for a longer period, then you invest them for that period. This brings us to another topic which is slightly related. These days, there is an introduction of Islamic banking. So many people prefer to use the Islamic modes of financing and Islamic banking modes. And there is a big move and a big growth in these Islamic funds and Islamic banking. So much so that most of the large banks, they have opened up branches or windows of Islamic banking for those customers who desire and who prefer to use Islamic banking. So when these organizations have these short-term funds available, then it will depend upon their motivation and their perspective whether to use interest-based conventional banking or to use Islamic banking for their funds. Both provide a return, and therefore The idea will be overall that when you have some funds available, those funds should be invested and a return earned for the organization. They also identify cash deficiencies which need to be arranged to meet the requirements. The overall aim should be to attain maximum cash availability and earn maximum return on idle funds. So as we have said, there might be periods, as you look at the balances for each interval period, there might be periods where the balance is negative. Balance negative means that the outflows are greater than the inflows. So in the same way as you can invest with banks and other institutions your surplus funds, you are going to need to make some financing arrangements with a suitable financial institution to fund this shortage of cash for this period. As businesses are running, their sales level and their purchase level is usually not even. In other words, it's not the same for every period, the exact amount of sales, the same amount of purchases, and that goes on throughout the period. Very often there will be opportunities where management itself will decide that they can acquire larger quantities of material, etc., for larger amounts which will last them not for the current period but for a longer period. So in order to capitalize on such opportunities, the management might make decisions where excess amounts of materials are purchased. These kind of situations can lead to what we are saying now, that they can lead to situations where outflows are greater than inflows. And so these kind of transactions will need to be separately funded through some banking arrangements. Now, if we look at the cash budget in the example that we have just seen, this cash budget has been divided into 4 quarters, and there is a column showing the total of the cash budget. The opening balance is taken from the opening balance sheet. What is the closing cash balance in the opening balance sheet represents the opening balance. In this case, quarter 1 shows opening balance of 34,000. Receipts from debtors, the information provided is that of 1 million. So that total funds available in quarter 1 is 1,034,000. Payments, purchase of material is 400,000. Payments of wages is also 400,000. This is all figures in the first quarter. Other costs and expenses are 120,000. So total expenses are 920,000, and the total inflows was 1,034,000, which gave closing balance at the end of quarter 1 of 114,000. The cash budget can be divided into whatever is the appropriate number of periods. In this example, we have divided this into quarters based on the information given. The information that we have used here of all the cash received and the cash payments is information that was contained in the question, and if you go back to the previous session, you will find the information has been provided. We saw that in quarter 1, you start with the opening balance and you add the funds that were received and you deduct the total payments. Payments were for purchase materials and for wages and other costs, and then you arrived at a balance. So you now have a balance at the end of quarter 1. We have said that this can be as frequent as the organization finds it useful. Most organizations, however, will prepare this cash flow virtually on a daily basis so that they know each day what will be the balance of cash. Cash, of course, is that kind of an important item within the organization because it needs to be, as we said, invested, or if there is a shortage, then arrangement needs to be made to fulfill the shortage amount. So our example shows quarter 1, we have the opening balance and the closing balance. Similarly, for quarter 2, we find the opening balance, which is the closing balance of quarter 1 is 114,000. The information on receipts from debtors, 1,200,000, which gave 1,314,000 as the receipts or inflows. Payments For purchase of materials, quarter 2, 480,000. Payment of wages, quarter 2, 440,000. And other costs and expenses of 100,000. So total payments in quarter 2 of 1,020,000, giving a balance of 294,000. Hence, this was the cash flow for quarter 2, the opening balance, the receipts, and the payments. Information on cash payments and cash receipts is going to be provided, or it sometimes might need to be calculated. We will see in the preparation of other budgets that sometimes you need to calculate the information to be incorporated in the cash flow, where you are making cash flow forecasts. So we have seen details of 2 quarters. Similarly, you can see the other 2 quarters is going to have a similar kind of information showing you the opening and the closing balances. And when the 4 quarters are put together, then we will find the cash flow for the entire period, in this case, the entire year. To add to that, after quarter 1 and quarter 2, quarter 3 and quarter 4, and you will come to the total for the full year. Notice that the total for the full year as opening balance is going to show the opening balance of quarter 1. That's now the cash flow for the full year. The balance at the start of the year was that which is the balance at the start of quarter 1, 34,000. And now the total of receipts that can be added, 4,305,000, to give the total cash available for the year, 4,339,000. Payments, again, the total payments can be put together, 1,867,984 are the payments, and wages, all payments of wages for the full year added together, 1,966,188, and other costs of 305,658. So total payments made were 4,139,830. The net balance after receipts and payments amounts to 199,170. This is the closing balance, which is the balance used in the balance sheet. So now we have seen the cash budget, we have seen the profit and loss account and the balance sheet, and we have seen therefore most of the information needed in the detailed budget. We started with the cash budget of sales. We started with sales, and then we went on to purchases and usage of material and inventory valuation, arriving at the profit and loss account, the balance sheet, and finally the cash budget. So this is the kind of information and detail of budgets that is required. You will make this budget as an estimate and forecast for the entire budget period, which is usually 1 year. But as we have said, that budgeting is something that must be constantly reviewed, figures must constantly be revised, and plans must be changed to reflect the current state of affairs, the current activities, and the current performance. We talked about the rolling budgets, the continuous budgets. So every month, therefore, the managers are encouraged to look ahead, and they are encouraged to forecast based on the existing current latest information. When all this information is put together, there can then be a review of all the information, and usually management will have a process to finally approve the budget. The larger the organization, the more complex and lengthy this review of budget process is. The larger multinational companies, they might start, for example, the budget process for the year from January to December. They might start this process in April. So in April, they would have started thinking about the plans and activities and business that is going to happen from January to December of the following year. So they have a fairly lengthy budget process. The larger companies, they have local offices which are country-based. Then they have regional offices which are a few countries together, and they are region-based. And then they have, of course, the headquartered offices which are the entire company in wherever in the world. So this process, the larger the organization, will have several review processes. The budget will first be finalized and reviewed at the local level. Next, it is usually presented to the region, and the region have their comments, and once they finalize and approve the budget at the regional level, it is then presented at the headquarters. And so a final headquarter budget perhaps might be approved in October or November of the year for the following year. So that's how budget reviews take place once all the detailed budgeting has been done in the larger organizations. And this review process, as we can see, can take 4 to 6 months. The reviews are going to look at not only the businesses, but they'll also focus on several other aspects of the business put together. They will look at the ratios, the financial ratios, how do they look, what adjustments need to be made, and they will then make whatever adjustments necessary from first a regional perspective, and secondly from an overall company-wide perspective, and approve the budget. If the review, once approved, will then form the budget for the forthcoming year and be communicated to managers. Final review. The budgeted profit and loss, balance sheet, and cash flow will be submitted to the budget committee for review. Financial ratios such as return on capital employed, working capital, liquidity, and gearing ratios will be reviewed. In the example, return on capital employed, or ROCE, is 20%, but the working capital ratio is 4 to 1. So management should consider ways of reducing investment in working capital before finally approving their budget. Different types of ratios are going to be examined, and we said in our example, the return on capital employed is one ratio which measures profitability. This shows 20%. That might be adequate for a lot of businesses. And then they will look, of course, at the ratios such as the working capital ratio. This will show how much is invested in current assets versus what is going to be the balance of current liabilities, and how do the current liabilities and current assets match each other. Normally, the companies will try to have this ratio as 1:1. In other words, the current assets and the current liabilities should be equal, or perhaps the current assets can be slightly more than the current liabilities to cover any contingency. In this company that we looked at, in our example, the working capital ratio is 4:1. That means there's far more money and investment in the current assets than there are current liabilities, and management will perhaps require the organization to reduce the investment in the current assets. How do you reduce investment in current assets? You will first of all try to reduce the level of inventory. You might try to reduce the debtors figure, and you might also try to reduce the amount of cash that is available and use it and apply it so that this balance of current assets and current liabilities is close to 1 or just a little bit more than 1, i.e. 1.2 or so. These are the kind of comments that will be provided in the reviews, and management will be required to take appropriate action and adjustments to arrive at the final budgeted figures. We are now going to talk about activity-based budgeting. For those indirect costs and support activities where consumption of resources does not vary with output of products, conventional budgets merely serve as authorization for certain levels of spending for each item of expense. Now we are going to see the different methods of arriving at the budget and what different processes can be followed in preparing the budgets. Very often, companies that follow activity-based costing, they also follow activity-based budgeting. The conventional or the traditional budgets, we have said that they are, the process usually followed is looking at the previous year, adjusting it for what is expected in the future period, and then coming up with the new budget. The slide just shown highlights that this kind of process can be looked at merely authorizing a level of expense. The budget process, the result is that you find that in the last year, for example, the expenditure on, let's say, travel, or let's say fuel, or other office expenses, admin expenses was X amount. And this year we're going to perhaps increase that by 10%, and it comes to X plus 10% amount. So it is virtually just authorizing a level of expense. The process hasn't gone through, and it has not looked at the expense, the nature of activities for which the expense will be incurred. This is a criticism of the traditional method of looking at last year, making an adjustment for the increment, and arriving at. Activity-based budgeting, we are going to see, is going to therefore change the process in which the budget is developed. It is not going to look at last year and add on. It is going to look at the activities. And so mere formality of setting an expense level, and the budget is then providing you just one level, that this expense, you have this much is the limit of this expense. And therefore just setting a limit for the expense to be incurred. Not looking at the usefulness, not looking at the need, and not looking at the waste or inefficiencies. Performance reporting normally implies little more than checking whether the budget has been exceeded. Under this traditional method, then, once you have just looked at the incremental basis of setting authorization levels, then what the performance has done, once you review actual with the budget, it will just simply be an exercise to see whether the actual has exceeded the budget or whether it has not. This on its own, it may be an objective to arrive and highlight areas where activities are beyond the budgeted level, but it does not see the inefficiencies and the need and the activities for which the expense was incurred. So performance is then just limited to seeing whether the budget has been achieved or exceeded. Very often we find that in several organizations that the budget is like a ceiling or a level or a limit. And there are times when organizations find that if they have not reached that limit, then they know then in the next year that limit will expire. So they allow themselves to increase their expense, whether needed or not, to the level of the budget, and therefore building in inefficiencies and things of that nature. So this budget process, this activity-based process, is going to highlight ways of trying to avoid these inefficiencies and this wastage. With conventional budgeting, indirect costs and support activities are prepared on an incremental basis. This means current budgeted allowances for existing activities is taken as the starting point. The base is then adjusted for changes which are expected to occur. This is called incremental budgeting. So this is like a criticism of the traditional and conventional budgeting process, which is also called the incremental budgeting. Meaning, you look at what is there in the previous period and you make an adjustment for either inflation or other foreseen increases, and you arrive at the new budgeted figure. So there is a criticism of this incremental base, and therefore a different basis and a different, more need-oriented basis should be followed for budgeting. That is what is activity-based budgeting is trying to tell us. Incremental approach to budgeting. An incremental budgeting, the expense may be based on the previous budgeted allowances plus an increase to cover higher prices. That's what we have said. Normally, incremental budgeting is going to be look at the previous budgeted allowance and add an adjustment to cover the higher price. The major disadvantage of incremental approach is that the majority of expenditure associated with the base activity remains unchanged. This point highlights the major disadvantage or criticism of the incremental or conventional budget. That the base activity, in other words, the previous period is taken as it is. Assuming the expense incurred in the previous period was, let's say, 100 rupees, we are assuming that that 100 rupees was correct for the previous year, and now we are only going to increase it for the next year. So whatever inefficiencies that occurred in the previous period, which we are saying is the base period for the current budget, that is absorbed and that is taken as the starting point. Whereas there might be a need to see whether the expense in the previous period was appropriate or was it already in excess. Past inefficiencies and waste is perpetuated. This is the problem, and this is what happens in the cases of incremental budgeting. To manage costs more effectively, organizations that have implemented activity-based costing have also adopted activity-based budgeting, or ABB. Once we have highlighted the problems that are being faced in incremental budgeting, conventional budgeting, we are now going to look at what activity-based budgeting does, ABB. And this is very often the case that those organizations which will adopt activity-based costing, and we have discussed activity-based costing, the organization which will implement systems for activity-based costing will probably like to move to activity-based budgeting rather than the conventional budgeting that we are just seeing. Activity-based budgeting. The aim of ABB is to authorize supply of only those resources that are needed to perform required activities to meet the production volume. In activity-based costing, we saw that costs were accumulated according to the consumption of resources by the products. So the cost drivers were used to identify and measure the amount of resources used by the various products. Similarly, in activity-based budgeting, we are saying that there will now be an examination of the activities that are required to meet the production level. Production volume has been set. We said the budget starts with the sales volume. The budget starts with the sales budget, including the volume and the price and the value. So once we know what is required from production, then we can try to measure the resources that will be required to meet that production volume. In ABB, cost objects are the starting point. Their budgeted output determines the necessary activities, which are then used to estimate the resources required. So now in ABB, the starting point is what we have called the cost object. In other words, the product. So first we have the product. We know what quantities are required, and then we measure from that what would be the services and what would be the resources required in order to make this level of production, this level of output. Starting point, therefore, is the production level. And the production level is going to define the resources needed. Stages in ABB. ABB involves the following stages. Estimate the production and sales volume by individual products and customers. Estimate the demand for organizational activities. Determine the resources required to perform the organizational activities. Estimate each resource, the quantity required to meet demand. Take action to adjust the capacity of resources to match projected supply. So once we are looking at activity-based budgeting, we have seen what are the stages in this activity-based budgeting. The start is the production and the sales volume. The production and the sales volume, similar to conventional, where we start with the sales. In this case, we are also going to focus on the production. Of course, the production budget is going to be based on the sales budget, but it will take account of opening and closing inventories. So the starting point will be the production and the sales volume, the volume that needs to be achieved. Then the activities of the organization will need to be identified. What activities need to occur to reach that production volume? And then identify the resources and the quantity of resources that are required to meet those activities. In a similar way as in activity-based costing, the cost drivers will be used. What will be the quantities? Here, therefore, what we are identifying is what would be the quantities of the cost drivers required to meet the production requirement. So the quantities are then established, and then the resources that needs to be made available. The resources will then be made available to meet that requirement. Now, this form of budget and budgeting is looking at the activities and the purpose of the expense, and they are not looking at just simply last year's expenses. So therefore, we have, in a way, a chance to review the effectiveness and efficiencies of the previous period. The first stage is identical to conventional budgeting. Next, ABB extends conventional budgeting to support activities such as ordering, receiving, scheduling production, and processing customer orders. Estimates of quantities of activity cost drivers must be derived for each activity. For example, number of purchase orders, number of receipts, number of setups, and number of customer orders processed. These were used earlier on as cost drivers, so the quantity of the cost drivers will need to be assessed. The third stage is to estimate the resources required for performing each activity drivers demanded. For example, if orders processing is estimated at 5,000 and each order takes 30 minutes processing time, then 2,500 labor hours of customer order processing time must be supplied. These are the stages in activity-based costing. We have looked at how the production needs to be estimated, the activities need to be estimated, and then the resources required to meet those activities, they need to be estimated. We saw the example that if you have an example needing 5,000 units of an activity such as order processing, and if you find that 30 minutes is what it takes for each unit of activity, then you are going to require 2,500 direct labor hours to fulfill that activity. In this way, you are going to make available the 2,500 labor hours. Activities are made available directly related to the quantities required for production. Inefficiencies can be reviewed and perhaps overcome, and therefore this represents a more effective and efficient way of arriving at the budgeted amounts. The final stage is to compare the quantity of resources required with resources currently committed. Where necessary, additional spending must be authorized in the budget to acquire additional resources. So, when the quantities have been estimated, the resources that are required have been arrived at and measured, and now it's the time to make those resources available. This will then be the stage where you will compare the resources required and needed to be made available with the resources that have been committed and which already exist. So then you are going to make the adjustment necessary in order to meet the requirement. And there will be times when additional resources will be required, and additional resources will be required and be made available in order to have adequate resources to meet the activities. This can sometimes be a difficult process, making additional resources available and therefore also reducing the resources available when the required activity is reduced. Very often within the organization, the resources that have been deployed, it can be a difficult and hard decision to reduce the resources. So those resources that can be adjusted, that are usually variable resources, those are easy to adjust and increase or decrease as per requirement. Many times, especially in different environments, it has a different effect. Taking on resources means perhaps hiring more new people, and therefore hiring and then reducing the number of people, it's not always an easy decision. It's not always easy to achieve, and reducing the resources is probably harder than increasing the resources. So this decision to make additional resources available must be done with good consideration, and the need should be accurately measured so that you don't find yourself in a position where after a short while you need to reduce the number of resources. It's better, therefore, to try to maintain a level and try to forecast a level for existing and committed resources and increase them only on a very well forecasted need basis. Alternatively, if the demand for resources is less, the budget process should result in action to reduce resources no longer needed. That's the difficult part we just mentioned. Increasing resources is easier. The budget process is going to identify, and it is going to attempt to lead you to make decisions to reduce, whereas it's not in practice always an easy decision to reduce the resources. In other words, the increase must be done, but must be done with great care and good forecasting. Budgeting in non-profit organizations. Budgeting in non-profit organizations normally begins with managers of various activities calculating the costs of maintaining ongoing activities. Then costs of further development of services are added. The available resources should be sufficient to cover total cost of such services. When we are looking at non-profit organizations, they are usually not out there to sell products and to make profits. So they are basically offering services which can very often be free of cost. So the focus is going to be on the expense side. You don't have a great focus on the income side. Very often there is no sales income. Non-profit organizations could therefore be more interested in offering the services and the quality of their services, and therefore the focus will be on cost and the costs incurred, and they will then be looking at what costs are required to meet the level of services which they are trying to offer. One difficulty encountered is that precise objectives are not defined in quantifiable way. Actual accomplishments are difficult to measure. So hence, when you are looking at the expenses and you are focusing on what expenses are going to be required, perhaps the important aspect for these non-profit organizations will be to make the necessary funds available. The funds required to offer the services and the quantity in which they are required, that perspective is required, that to make the funds available is what perhaps will be the challenge. Very often in these organizations, therefore, the results are not going to be measured in money terms. They are going to be measured in value terms, in quality terms, in the response from the users. This makes it harder. So very often it's harder to assess performance, and it's harder to assess the degree and nature and quality of services provided. That's all for today. Thank you very much.